SaaS software companies have been under a lot of pressure over the last 6 months, and it really has surprised me. I've worked in the software space for a long time, 25 years plus, over 20 years at Oracle. I worked at SAP. I also worked at Sage Software. I've implemented software, I've used software, I've consulted businesses in using software. So it's right in my backyard of knowledge, and I've been surprised. So I wanted to dig deep, do some research, and share that with you, and share with you how my point of view has changed. And it's changed to really recognize that agentic AI has really changed the game. It's changed the rules for these companies. And I wanted to cover that and share with you why my point of view has changed. I'm a stock investor. I need to be able to make a decision most of the time accurately about how a business is going to perform in the future. And in this case here, my expectations were wrong. And I want to account for where my thinking has been off and recalibrate. In some cases, I still feel quite bullish on some of these stocks, but in other cases, I am now more bearish on some of these software stocks. And I'm going to go through a good number of them. So we'll research this together and I'll share my point of view, my analysis with you. I look forward to seeing your comments on it. So, for starters, the software business has been a great area for investors to grow wealth. Microsoft, if you look at the return, historically, it's just massive. Oracle, massive. Adobe, tremendous. Every one of these stocks has delivered tremendous multi-bagger performance over the lifetime of those stocks. But the last 6 months have been brutal, absolutely brutal. The great Microsoft is down 29%. This is a business that's growing more than 20% and profitable in strategic businesses that it could really, I expect they're going to own. They're going to have market share leadership in a good number of categories that they do business in. Oracle down 50%, Adobe down 30%. And Adobe's problems have really started more than a year ago. AppLovin, which I consider a software application, down 34%. And this stock has had periods of really good rallies. ServiceNow down 44%. All the companies I just listed are growing top line revenue. All the companies that I've listed have high profit margins. So what's the problem? The problem is that the story that agentic AI is going to threaten these companies and reduce the number of licenses, software seats that these companies would sell. That's the story. I'm going to share with you some content that I've learned, that I've updated my knowledge base. I'm also going to share the fact that more recently I have started to develop software using Claude and Gemini, and I've started to successfully use OpenClaw as an agentic AI application. And I have been absolutely impressed with all three of those technologies. And it really has transformed me from, I wouldn't say I was necessarily a skeptic to begin with. I would say that I was cautiously optimistic that AI was going to deliver a lot of value. A couple of years ago, I just viewed AI as being an excellent chatbot. It provided generative AI, which was, I would ask questions, we'd build kind of a repository of information based on a thread I would establish with that generative AI application. And they did a great job. But now AI is doing things. AI is completing tasks. And that's what begins to threaten these software companies. Let me share with you why. So for a long time, software companies were a really desirable business. They had terrific margins, high revenue growth, and now that's under attack. Why is it? Well, AI has become so good that it's going to take on the task of doing things for companies. It's going to do these tasks and replace junior employees or maybe reduce headcount at companies. And that's going to spell fewer licenses sold by software companies. Companies like Adobe that produce software to create images, video, and so forth, they'll be under pressure because you can use an AI model to create that software. And basically, it comes down to the fact that if a software company has a simple use case or a one-dimensional business that satisfies one line of business, as an example, they're going to be very vulnerable. Where software companies that are quite complex and manage a very complex work stream that hold the data, they're going to probably be more resilient and stick around longer. But they too will have to redefine their businesses. So at this time, I think the moat, the way I see the moat for SaaS businesses has changed. And I'm going to show that as an example later on. But for now, software industry has changed overnight. And we'll see which software companies can adapt, which ones can thrive, and which ones are not going to exist in the future. Additionally, the moats of these companies are really under threat. And I'd like to give credit to another YouTuber by the name of Phil Smy, who I really encourage you to follow him if you're interested in this topic. He has a lot of great things to say. And I really agree with him, having worked at software businesses for more than 25 years, knowing what I know. The moats of these companies, that has changed. And it really is defined by, is the company owners of the software, the code, and is it a complex machine behind it that can't easily be repeated, replaced, and copied? Is the software company, managing a very sensitive data set? Are they doing business with large companies? The more complex, the bigger the moat. If the company manages complex work streams, the bigger the moat. If that company owns the entire tech stack, the bigger the moat. On the flip side, if you have companies that have survived really selling a feature that uses somebody else's data model, somebody else's tech stack, and is really solving just one area of business, there's no moat there. That is very vulnerable for either the large language models to be able to complete that task, or a company can just create their own solution. A company can create a solution and then integrate it to one of these larger systems. Let's say an SAP. You can integrate to SAP to solve that unique requirement for one of your lines of business. So big credit to Phil Smy. He really did a great job in understanding this space. He has a lot of years of software developing. He started companies and was successful. And I learned a lot from his video. I encourage you to watch it. But it really helps me understand how have things changed for software companies. The moats clearly are different. They're different than the moats that I thought they had. And that's going to change how I value these companies. That's going to change how I invest in these companies. Let's take a close look at Microsoft. Now, everybody knows what they do. They create software a lot for our desktops. They do big software for big businesses. They run a cloud infrastructure business, Azure, and they do a lot of other things. And when we look at their forecast, this business is supposed to thrive. 17% growth on earnings per share, 19% growth, 22, 27. Their revenue is going to do great. This is a big enterprise. They're going to grow this year by 18.7, 15.5, 16.5, and 15%. So why is the stock under so much pressure? And why is the market pricing this company, which is an exceptional company, with such a low PE? It's this story. It's the threat of AI. When I complete a valuation of Microsoft, I think the stock is slightly discounted. And I think it's slightly discounted because when I grow their revenues, their free cash flows by 18%, and I grow their earnings per share by 18% and give them a 25 PE, the stock is priced a little below their intrinsic value. That's not a wild discount. It's not compelling, but it is an exceptional business that I think is going to prove the naysayers wrong. But you see how this story has really brought down the Microsoft stock price. In some cases, I think individually, stock by stock, the story is going to be right and the story is going to be wrong. And I think for Microsoft, the story is wrong. Now, let me talk about Oracle. Oracle is historically the best database company. They run a very strong software as a service business that does ERP, CRM, HCM, very complex work streams. And I think that business is going to be hard to penetrate, hard to beat. They're also growing their cloud infrastructure footprint very rapidly and taking on a lot of debt. And the company is going to grow quite well. The Growth in this fiscal year is going to be 19.5, and the next year 32% revenue growth, 47, 39, and this is a big business. So these are really impressive revenue growth numbers, and their profits will expand as well. But you look at their PE ratio, it's supposed to come down to single digits. This is a high revenue growth, high profit company. The problems do lie with Oracle. Their balance sheet isn't very good. It's actually risky because they've taken on so much debt, and they have negative cash flow. When I value Oracle, I'm showing that the stock is priced too high. They're not generating any free cash flow. Their balance sheet really worries a lot of investors, which is why the stock's down 50%. So it's a story that AI is going to hurt Oracle substantially, right or wrong. This one is a coin flip. I think part of Oracle, their SaaS business, is going to be tough to replace. They are installed at very big companies managing very complex work streams. So the software as a service business is pretty strong and has a pretty good moat. But most of their investing is happening on the cloud infrastructure side. And I think there they have plenty of competition from Amazon's AWS, Microsoft's Azure, Google Cloud, and others. So I think that's where the vulnerability lies. And overall, I think Oracle could be hurt by the whole AI trend, where AI companies will see lower costs in the future and probably shy away from using Oracle's cloud. If they do and Oracle can't sell their capacity, this business will be in trouble. And they're not generating any free cash flow. So investors like me don't have a very positive opinion and outlook for the company either. SAP is one of the biggest software companies in the world. They've been around for a long time. They handle everything for a business from financials, distribution, manufacturing, HR. Very complex work streams are managed in the SAP application. Looking at their forecast this year, they're going to grow by 10%, 11, 11, and then 16. So it looks like analysts are not expecting a disruption due to AI. And the profits are expanding nicely as well. And the PE ratio is dropping, even though SAP has very good margins. I completed a valuation on SAP, and it's a good opportunity. The stock is discounted by 27% when I value the company based on the present value of its future cash flows, the present value of its profits. And you can see the big decline that has happened as a result of this story that AI is going to hurt SaaS companies has priced the stock quite attractively. Now, is the story correct that agentic AI is going to take away a substantial amount of revenue from SAP, or is it incorrect? For SAP, I think the story is incorrect. SAP manages the most complex processes there are to manage: manufacturing, distribution, HR. And they do it quite well. They're a little bit of an expensive product, but big businesses really appreciate that they're a complete solution. So SAP looks like a pretty good opportunity. And I think SAP is going to prove the naysayers wrong. Adobe has been hard hit by this AI story. And looking at their forecast, this year they're supposed to grow quite well, almost 12%. Next year, 9%. And the year after, 8.6%. And then this revenue is slowing down, which is concerning. What's also concerning is Adobe just had their CEO announce he's going to retire. And part of his comments were that he just doesn't feel like he's the right CEO in the AI era. He's 62 years old. He's done a lot of great work for Adobe, but he might be right. And there's no CEO identified just yet. So I think that's part of the sell-off reasons. But overall, this stock has been really, really under pressure. When we look at the profitability growth, this year, they're supposed to grow by 43% on the profit. And it's going to continue to grow. But again, it's slowing down in 3 years. That is concerning. The forward PE is already really low at 10, and it's going to get down to single digits. When I complete a valuation on Adobe, it looks great. There's a lot of cash flow. It's a very profitable business. But this is setting up to be a trap. The story on Adobe that AI could replace a lot of its features, I think it's accurate. When you look at Adobe, it has a lot of single features that could be addressed by Gemini, Claude, ChatGPT. It could be addressed by Alibaba in Asia. And I think a lot of the users could abandon using Adobe software and they could begin to use one of these other all-encompassing large language models. So I think the story that AI is going to tear down the moat for Adobe is correct, even though it has a strong valuation strategically, qualitatively. I'm concerned about Adobe. DocuSign is a perfect example of a single feature business that it's going to be very vulnerable. DocuSign is, in essence, they exist to do digital capture. And they're not part of a bigger solution, a bigger, more complex solution that manages a complex work stream. The revenue, if you look at the forecast, the year they're in is they're supposed to grow by 10.5% and 7.4%. And you see that the growth is slowing down. I think they're going to see newcomers into their space, more competition. And their forward PE ratio is really dropping. It's a very profitable company. I think their business is very vulnerable. When I value DocuSign, again, it gives me a strong valuation. But qualitatively, I think that DocuSign is very vulnerable. A company could design digital capture features into a larger software program. Let's say a Salesforce can start delivering digital capture as part of their software and do away from the need of having a third party, a partner, DocuSign, do that task. And it can go on and on. ServiceNow can do the same thing. Amazon can do the same thing. So I think DocuSign is a perfect example where the company doesn't possess a broad enough footprint that a customer uses that's complicated enough to be very sticky. They're just there for one particular task, one feature, and DocuSign is very vulnerable and high risk stock, in my opinion. Here's an illustration of where a lot of these software stocks land. Let me take you through it. First, what are you looking at here in these quadrants? I measure the desirability of a business and its moat, really addressing what is the strength of that moat. Does it have the ability to fend off competitors? Does it have barriers to keep competitors out of its market? And is it able to grow, profit, and provide free cash flow? Probably the best example of a quality business is going to be Microsoft. It does have competitive advantages, in some cases, almost a monopoly if you consider DOS, if you consider some of its desktop applications. It also has dominant share in Azure and other markets. Its network is really powerful. So that definitely has a very strong moat, and it has been growing. Even though they're big, they have very high growth percentages. And I think Microsoft is going to be a strong business in the future. AI is not going to hurt it. It actually could be a great opportunity for them. Palantir is a software company. They are classified as an AI company because they do a lot of really advanced things, and they are growing at very high rates. They have a very strong moat because their software is very unique and it handles very complex workloads, very complex analytics. It does a lot of AI, predictive AI, that is really mind-blowing. So these two companies are great examples of companies that have very strong moats and should be fine in the future. Now we have some businesses that are going to be okay, in my opinion. They're just not going to be as good as Microsoft and Palantir. Salesforce. Salesforce has a very broad customer base. They handle very complex business streams and workflows. They control the data. They provide a platform that's going to be very hard for customers to replace. So I think Salesforce is going to have time to adjust. They're going to have to recreate themselves and have excellent AI experiences in their software. They're not as strong as Microsoft, but most definitely they have a lot of desirable aspects. So I put them in between the green and the gray. They have a good moat. They have a good ability to grow. The other company that resembles Salesforce is SAP. I think they are going to be very hard to replace in any one account. Maybe they do see some stress from companies not hiring as many employees, and they see some revenues go down on user counts, but they can grow. They can grow and provide new products that are AI oriented to their customers. Oracle's in the same boat. Oracle and SAP compete against one another, and they have really strong SaaS solutions that are very complex and are going to be very hard to replace in companies. Their cloud business is what worries me, but overall, I think Oracle is going to stick around for a while. Now let's get into the stocks that I'm a little more nervous about. I mentioned DocuSign earlier. It's a single feature company. So their moat is not going to be as good as it should be. Their ability to grow is also not very good. Zoom is in the same category. Intuit is a company that does primarily financials, tax software, and some MailChimp services as well. And theoretically, you can replace a lot of those, work streams. So it's a matter of, will their network, their brand be enough to fend off competition? So Intuit is investable at the right price, but know that there is risk in investing in Intuit. Adobe, there's a lot of risk in investing in Adobe. I think they could come under threat. It's going to be interesting to see if Adobe can use their brand and network and innovation to show that they have really great AI products that customers are willing to pay. AppLovin, I think, is going to be vulnerable over time because they do real ad tech. And I think that is a narrow feature set that could be replaced by AI or a competitor. And some companies that are really, really vulnerable, Fiserv. Fiserv does payment systems. They're already struggling to grow. Payment systems, it's a crowded marketplace, but most definitely companies could develop their own payment systems. Amazon, I'm sure, developed their own payment system, but other companies could use Claude to write code and have a payment system. They could have OpenClaw or CoWork do the payment processing as an example. So I think Fiserv and FICO are uninvestable for me because they're already being threatened. I think the story is already kind of taking place at these two businesses. So that's where I stack rank these companies. Overall, if I look at how I viewed software companies a year ago, it was far more optimistically. I thought that software companies would have the ability to innovate and actually be a part of the AI wave and provide products that would just wow customers. That didn't happen. But what did happen is a lot of innovation happened on the AI side. OpenClaw, CoWork, Claude has become a fantastic platform for software development. Gemini's gotten really strong. OpenAI was already super strong. And you have new solutions coming to market. You have the Chinese large language models really impressing people as well. So my point of view where I was incorrect was I thought software companies were going to be able to innovate and provide products that would, in essence, probably enable them to grow. That just hasn't happened fast enough. And the innovation curve on the AI side, it is moving way faster than these software companies can adapt. The speed that AI is moving with is incredible. And what it's doing right now, April 2026, is really darn impressive. OpenClaw is almost magical how it could actually do things for me. And it's open source, it's free. That's awesome. As we see more and more of these innovations, it's going to put more and more stress on software companies. And this is an industry where innovation wins. The best ideas tend to get market share. Right now, AI is really delivering. I couldn't say that a year ago. I would say that a year ago, I was still looking for the big innovation, the big value being delivered. And I could totally see it today. A year ago, I expected these software companies to really step up, innovate, and take advantage of all this attention on AI, but it just hasn't really been enough. I think the perception is still that the pure play AI companies are going to take share. They're going to take share of user time, market share of work streams, of data, and that's going to put some companies under stress. Microsoft, Palantir, I think they're going to remain strong. The strong are going to stay strong. The weak are really going to be punished. And the companies in the middle, I think they either need to step up, innovate, get creative, adjust, or they're going to move down the rungs and become a very vulnerable company. I imagine employees are looking at this and trying to determine, am I with a software company that is going to stay strong? And maybe you're early in your career. I would really think about it and maybe try to go to a company that has a bright future, that has great ideas. If you're an investor, the risk in investing in software companies is much higher. It's much higher than I estimated a year ago. And I'm adjusting my point of view and adjusting my valuations and adjusting my plans to invest with caution into software stocks. So overall, the end user wins with innovation. Being an end user, I love using Gemini. I love using Claude, OpenClaw. They do so much for me every single day. And for the most part, those platforms are free. I pay very little to use systems that are just so productive and capable and powerful. And I'll gladly continue to pay a little bit for that. Well, if I'm getting that much value for very little spend, where does that leave software companies? I think that in itself proves that there is a new way of thinking about software, and these businesses will have to adjust, and they'll have to do it quickly because AI is moving fast. So that's my analysis on software stocks, software companies, how things have changed very rapidly over the course of 1 year. I'm just blown away by how the situation has changed, and I am pivoting. I'm changing my point of view and addressing the risk in these businesses. As I invest in software companies, I will be much more careful going forward. So that's my analysis on software stocks. I hope you found it interesting.